Adobe is a great company, and the fact that they're down 50% over the past year is very surprising to me. So the question is now the time to purchase the shares of this great company with a wide moat? That's what we're going to cover in this video. So guys, smash that like button, subscribe if you're new. You're watching More Money. Let's get it. What's up guys, and welcome back to the channel where the goal here is to help at least 1,000 people achieve financial independence much sooner. And let's dive right into it. So you can see here that over the past year, Adobe's shares were once trading at approximately $688 per share, so almost $700, and now they're down 47% from its high as of the recording of this video. So the question is now the time to buy this opportunity? And that's what I'm going to dive into. So you can see here that this is largely a 3-segment company. You have digital media, digital experience, and publish and advertising. And if you're not familiar with it, no problems. I will dive into those segments momentarily. But you can see that because the digital media segment has been growing so fast, Adobe's largest segment now makes up 73% of the company. Digital experience, their second largest segment, makes up another 25% of the company. And so that third segment is pretty much irrelevant. But going back, you can see that I wrote a note here saying that Adobe is basically a 2-segment company that's actually quickly turning into a 1-segment company focused on digital media, unless they can really deliver on their growth expectations for the digital experience segment, which they'll try and go after, and I'll explain it to you when I dive deeper into that segment. Now, starting first with the digital media segment, you can see here the digital media segment consists of their Adobe Business Tools suite. That's more aimed at business customers. And then they have their Creative Cloud suite. So that's what you will think about when you think about like YouTubers who use Adobe Premiere Pro to make their videos. Let's start with their Adobe document business. You can see that the Adobe document business is the industry leader for a reason, because you can do so much more with Adobe than you can do with other services. Now, I'm not saying that there aren't other PDF services out there. There absolutely are. But anytime I worked at a company that had access to Adobe's suite of PDF softwares, it made my life so much easier. For example, just the ability to convert your PDF into Word was such a big deal. And plus, just manipulating PDFs, adding notes, all of that stuff, combining them, ripping them apart. When I spent time at the audit firms at KPMG, that's exactly what we used because it was so good and it was so easy to use. And that was 10 years ago. I can only imagine how much better the software has gotten now. You can see that this is their Creative Cloud segment. This is the big deal. This is what's been growing out for them significantly over the past few years. The Creative Cloud has a host of apps. Personally, I use Photoshop and Premiere Pro, and in my experience, although these products have substitutes, I rather actually pay a premium for especially Premiere Pro, because if I run into any issues like I have run into during my YouTube journey, there's so much information online from people who've experienced the same issues, and so I can resolve these issues very quickly. So there's a huge ecosystem which forces me to pay more for Premiere Pro to have access to that ecosystem of knowledge. I'm not a huge expert with audio and video. I'm a finance guy, so it pays dividends to have access to this type of ecosystem. And like when I talk about the price discrepancy, I have probably paid maybe 20 times more for Adobe Premiere Pro than I have for a rival software. But at the end of the day, it doesn't matter. It's insignificant in terms of the cost relative to what you generate from YouTube anyway. So it really doesn't matter. And so that tells me that Adobe has a huge moat. In fact, a wide moat over this software. And it tells me that it's going to continue to grow. You can see how wide their moat is. Huge gross profit margins are generally an indication of a wide moat, as well as the ability to remain insulated from long-term impacts from inflation. And you can see that going back as far as 2012 and probably even before, this company is generating gross profit margins close to 90%, which is absolutely nuts. You can see that the strategy for this segment is very clear. They want to be the backbone of content creation. And at least from my perspective, I think, at least in my mind as a consumer, at least I think that they're there, and they'll continue to widen this moat as time goes, as they continue to push out improvements to the software. But we'll see how this goes. Let me know, guys, in the comments if there's a competitor coming up that's going to challenge at least Premiere Pro. But now I want to offer you something. When a business focuses on a particular segment, they can actually introduce new risks into the business. Now, this is what I mean by this. The past 7 years have seen a huge explosion in the digital media segment's growth, with a growth rate CAGR of 24.5%. That's absolutely nuts. And what has happened is this segment has now become much more important to the company overall, where it went from 65% of the company's overall revenues to now 73% of the company's overall revenues. So why do I say that this is a risk? Well, when you have most of your eggs in one basket and that particular segment runs into a economic downfall or sort of like an economic sort of recession for that one industry as a whole, then obviously you're tied to that industry. I'm not saying that the content creator business is going anywhere, but what I am saying is that it just makes it more of a one-trick pony. So as it stands right now, I don't see a huge risk from this particular business because the margins are so high. I think they can continue to concentrate in this business. But the only reason why I bring it up is because we recently did see something similar. For example, Walmart, over the recent few years, or I guess over the recent decade or so, they have really pushed hard to get into groceries. Well, grocery is a lower margin business. And so as you can see recently, they actually took a hit and the share price declined because the grocery market took a hit because inflation roared its ugly head. Now, I'm not saying that that's going to happen to Adobe, but what I am saying is anytime I'm looking at companies, I'm trying to identify risks. Where can they screw up the business? And what are some sort of like the mitigating items that can sort of mitigate the risk there? And what I'm saying is they're moving more to just this one segment. However, this is a high margin segment and it's pretty diverse in terms of the types of people that are using it. So I think they're okay. However, I'm going to keep my eye aware of emerging risks as they come on. You can see why I believe that the risk is pretty mitigated. This is Alphabet's financial statements, and the Patreons actually have access to this, and the Patreons actually have access to the previous statements that I have shown you too that look the same as this. And so you can see here that YouTube is growing fast, and it's expected to continue to grow at high rates, i.e. the creator economy is continuing to expand. So you can see that since 2018, YouTube ad revs have grown from 11 billion to 28 billion. So almost a 3x for Alphabet. And going forward, you can see that I'm projecting 30% a year through 2023 and then dropping it down to 25% and then 20% in 2026. So you can see here that there's huge blue ocean for the YouTube creator space as seen by the forecasted ad spend on YouTube. So it makes a lot of sense that if YouTube is going to be doing well, and that's an indication of social content continuing to grow and continue to get monetized, then obviously there's the creators that are utilizing the backbone of the creator economy, such as a Premiere Pro or Adobe Suite products, will continue to grow, and that's exactly what we're seeing here. Now, when it comes to their experience segment, that's at 25% of overall revenues. You can see this is a good example of what this segment consists of. So you got your data analytics. I don't know what sort of data analytics that they provide. I really got to dig a bit deeper into this because I would think that the guys that would win on the data analytics space would be Microsoft. And so it'll be interesting for me to learn more about that. They have their content, which is really good. And then they have their customer experience with digital assets. I call it that. They call it their customer journeys. And so that's really just how do you get the customer to experience the digital footprint of the brand. And then of course they have their marketing subsegment of this digital experience segment. So that's largely what it is. And you can see that it focuses primarily on businesses. This isn't really a creator focused segment, but I do believe that as more and more companies focus more and more on their digital space, this segment becomes more and more important. And I think overall, this segment continues to grow. I think the segment has huge blue oceans into the future because I think that many companies are underappreciating the importance of their digital space. And as my cohort moves into sort of like the executive management level, I think we just have a better idea. People who are in like their mid 30s or so, as we move on and take over those C-suite jobs, I think we have a better appreciation because we sort of grew up in the digital economy. And so I think more and more companies are going to start embracing it with more and more senior people overseeing this activity and less of it just being a marketing job or a revenue job. It'll be more of an operations type function where the whole company gets integrated and the digital experience gets built out from the perspective of the whole company. So I think we're going to see more and more of that as time goes on. I might be wishfully thinking, but I think that's a direction that we're going. And so I think this becomes more important. And I think that the total addressable market continues to grow year over year. And you can see Adobe actually talks about that here, where they're saying that in 2023, they believe that the total addressable market is approximately 85 billion. And in 2024, they believe that the total addressable market is going to grow to approximately $110 billion. And so Adobe believes that this market is growing rapidly, and they only have $4 billion in revenues. Thus, they hold a small portion of this overall large and growing market. So now, can they deliver? We will see. That's a big question I have for Adobe. Are they a one-trick pony, or can they continue to deliver in this space? I truly believe that they can. Let's see how this rolls out. Now, when it comes to capital allocation, it's very exciting to me that when the share price declines, companies pick up their share price repurchases. And you can see here that that's exactly what they're doing. They're actually accelerating the pace of their repurchases in fiscal year 2022, and that's really good. I'm a huge fan of accelerated repurchases when the shares are down. But the one thing that I like to pay attention to is whenever companies announce huge share repurchases or repurchases in general, I always ask the question, are they just repurchasing shares that they have issued to management? So the one area that I like to look at is the cash flow statement. You can see here, and once again, the Patreons get access to this at the lower tier. Stock-based comp as a percentage of free cash flow is actually trending down, and hopefully it's going to soon be under 10% of free cash flow. That's that sweet spot I like. I like seeing stock-based comp under 10% of free cash flow, and it looks like that's the direction that this is going. So as the company continues to grow out, that free cash flow is going to become higher and higher, and the percentage of that free cash flow, I expect a lower and lower amount of that is going to be dedicated to stock-based comp. So that's a big win for owners, and it shows you that this company is owner-focused. But it's not all good news, right? Growth is slowing. So one of the reasons why the share price has declined so much this year is, if you can see here, their growth expectations for each of their segments has gone down. So you can see at the top, their creator segment, it grew at 25% last year, and now they're expecting it to grow at approximately 14.5%. Their digital experience segment grew at 23.7% last year, and now they're expecting it to grow at 14%. And overall, their revenue grew at 22.7% last year, and this year they expect it to grow at 13.4%. So their fiscal year 2022 guidance is at $17.9 billion. And you can see that 17.897, that's effectively $17.9 billion. That's what I'm forecasting in my model. And you can see that subsequent to this year, so 2023 and beyond, I'm not growing the company's revenues at a high rate until I get a little bit more information as to why they would re-accelerate growth. And so I'm not really sure on that story yet. I need to learn more here, but here's an opportunity for you guys. So if you are a Patreon and you download the model, really think about what these segments are going to do in the future. I think there's some upside potential here. In fact, there could be a lot of upside potential, especially that digital creator segment. It doesn't make a lot of sense that I'm forecasting Alphabet's YouTube ad revs to grow at 25 down to 20%, but I'm not forecasting Adobe's creator segment to grow at approximately the same rate. Doesn't really make a sense. I understand that's not a one-to-one link, but at the same time, it seems like there's a bit of a disconnect there. So where am I wrong? Am I wrong on the YouTube ad spend growth, or am I wrong on Adobe? I'm not sure. You guys let me know in the comments what you think, but I think there's some upside to my valuation. Now, speaking about my valuation, as you can see, even with a high multiple of 25 times earnings, the company still looks slightly overvalued at the moment. But this is one that I'm watching, and I'll look to buy it at a 25% discount to its intrinsic value. Normally, I like a 50% discount to their intrinsic value, but this is one company that I think is so future focused that I would buy it at a 25% discount, which would obviously be more than a fair price. But like I said, my valuation may be low because I may be projecting slower growth for their digital segment that is actually warranted. You guys let me know in the comments below what you think. What am I getting wrong here? And of course, guys, if you guys want access to all of my models and the tracker that tracks in real time all the stocks that we're following, you can get that at the lower tier of the Patreon. And like I always say, there's never any risk to you, because if you do decide to try out the Patreon and you decide that it's not for you, message me in the app before you cancel, just to let me know that it wasn't for you. value because I don't want to take your money if you didn't find value from it. Now, here's the cool thing. We're closing in on approximately 150 Patreons and nobody has taken me up on that offer yet. So that's really cool. Now, the other thing that I want you guys to really pay attention to is investing in Chinese stocks could potentially be banned if US legislators get their way. And I discussed that in this video right here.